Hi and welcome to Swissquote's Daily Market Talk. It's Friday, March 21st. The Fed optimism didn't last long. The tariff fears are back again. The rotation trade toward the European and Chinese markets seems to be slowing down, and the sell-off in the US dollar is now giving signs of exhaustion, hinting at a period of pullback in other currencies' valuations against the US dollar. So in this jungle of uncertainty and rising inflation fears, the energy stocks and tips actually see an increased appetite. So a big week of central bank decisions is coming to an end, with the central bankers around the world bathing in uncertainty of the tariffs and the economic implications of the rapidly escalating trade war. So if we quickly summarize what happened this week in terms of central bank decisions, the Fed maintained its rates unchanged this week. It cut its growth projections, lifted its inflation forecast, said that a tariff-led pickup in inflation in the US would be transitory. And yes, we all laughed and decided to reduce the pace of the quantitative tightening. Then, the Riksbank maintains status quo this week while signaling the end of the policy easing. The Bank of England kept its own monetary policy unchanged. The BOE's head, Andrew Bailey, also told investors that there is too much uncertainty out there, even though he actually knew that this is the last thing that the markets and investors wanted to hear over and over again. But there is uncertainty. What do you do? Meanwhile, the Swiss, who actually benefit from the winds of uncertainty globally and see their Swiss franc take a lift again, went ahead and announced a much expected 25 basis point cut yesterday, because the Swiss, they just don't want to see the Swiss franc fly high again when inflation sits at 0.4% on a yearly basis, which is quite low. As a result, the Swiss franc and sterling fell yesterday on Swiss National Bank's rate trimming and Bank of England's uncertain outlook regarding the future, respectively. The SMI index in Switzerland gained in a session that saw the other major European indices pretty much offered elsewhere, while the FTSE 100 index closed near flat, still outperforming most of the European index complex, hit by an overall pessimism. The US stock markets, on the other hand, couldn't extend the Fed optimism into a second trading session, as FedEx, which's results are seen as an indicator of economic health, lowered its profit forecast for the third straight quarter. So, the rapid loss of appetite now hints that there is a stronger case for a further sell-off in the US stock markets than a sustainable rebound. But don't be worried too much, because this is not bad news per se. The good news here is that a period of economic slowdown doesn't necessarily mean lower asset prices. Why? Because the central bank policies tend to be supportive of the markets in periods of economic slowdown, and that actually helps maintain markets afloat. It is magic. And also, periods of price corrections are not a bad thing per se either, especially for investors who were quite reluctant recently to enter the market at peak prices and high valuations. As such, a period of consolidation and market correction is, well, quite the best time to review the company's potentials, actually, and also chase interesting entry opportunities. Because look, Nvidia has seen solid support into the $105 level, and the company's PE ratio has now fallen to 40 from above 70 that we have been seeing over the past year, for example. Still high compared to the average of the S&P 500 companies, but the stock is much cheaper today compared to, I'll say, 2 months ago, because the earnings expectations at Nvidia, for example, continue to be strong as they were 2 months ago, and the AI investments around the world continue to flow in. It is just that the global headlines are more crowded with tariff and Trump news and rotation trade than the AI news. And speaking of rotation, capital flows toward the European equities were the major theme of the first quarter of this year, as you may have noticed, but flows toward the European equities and the euro could actually start slowing in the second quarter, as many investors now consider that most of the upcoming European infrastructure and defense spending is already priced in, baked into the market prices. As such, it looks like the euro-dollar consumed its short-term upside potential and could opt for a deeper downside correction from the actual levels before finding the courage to re-challenge the 110 resistance. The pair should actually see some minor support near the 107.80 level, which is the minor 23.6% Fibonacci retracement on this year's rebound, and some major support within the 106.75, 107.30 range, including the major 38.2% Fibonacci retracement on this year's rebound and the 200-day moving average respectively. And price pullbacks could actually be interesting for tactical shorts, but note that the base case scenario here for the medium run, say a month or to 3 months horizon, is still bullish for the euro dollar, meaning that the price pullbacks that we will see in the next few weeks are still considered as interesting opportunities to strengthen medium-term long euro positions against the US dollar, with the expectation of a sustainable attempt above the 110 psychological mark. Elsewhere, the Japanese yen is softer this morning at the time I'm talking here against the US dollar on the back of soft inflation figures in February and a broad-based rebound in the US dollar. Now, I sense that the US dollar's weakness that started by mid-January this year could be gently coming to a bottom, and we could eventually see a rebound in the US dollar across the board, at least in the short run. Now, another leg of the rotation trade is also showing signs of weakness this week, and that is the Hang Seng index that has been performing quite well since the beginning of this year, but was down by more than 2% yesterday and shed another 2.40% today on the waning Chinese stimulus-backed purchases and the tariff shenanigans. But note that I continue to like the Chinese technology stocks, especially the technology stocks, and think that Nasdaq's Golden Dragon Index has room to close its gap with the Nasdaq 100 stocks for the next 3 months of trading at least. Now, one other interesting pocket of the market to hide in an environment of high uncertainty, high valuations that are coming down, appetite loss, and rising inflation expectations is oil and gas stocks that are sure dealing with lower oil prices since the beginning of this year, but that are lucky enough to be in a sector that will be explicitly supported by the Donald Trump administration for about 4 more years, that pay good dividends to its investors, that also do offer strong buybacks, and that could simply ditch the expensive plans of this green transition and clean energy to focus on money-making traditional fossil fuel business. So in this context, SPDR's energy sector fund has been outperforming the S&P 500 peers since the beginning of this year and should continue to see stable inflows from investors who are actually looking to hedge their portfolios against the risk of surging inflation. And in the same context, getting exposure or increasing exposure to TIPS, so the inflation-protected bonds, is also an interesting portfolio strategy right now. And Invesco's 0 to 5 year TIPS ETF is up by around 2.86% since the start of this year and has certainly room to extend its gains. Now, next week, we'll be shifting our focus toward the PMI numbers, the US growth update and core PCE update, and British inflation and budget. So we can't wait to be there. But first, weekend. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.